Okay, so can we turn the cameras on and we will start the meeting.
We are recording.
Thank you. Does that mean that the cameras are on and we can start, Diane?
Mikhail, camera's on.
Great, thank you. Okay, good morning, everyone. Welcome to the New York City Retirement Systems Common Investment Meeting for Wednesday, December 16th, 2020. You could be anywhere in the world this morning and you chose to join us here. So thank you so much. Okay, so with that, we will start roll calls. And let's start with the Fire Pension Fund. I'm not sure, is it Pat, are you here? Or Leroy?
Yes, I am, John.
Morning, John. Leroy's here. Yes, Patrick.
Okay.
Go ahead,
good
Pat.
morning, Mr.
John,
Dunn.
do you have me?
I have you.
Okay, for Mayor de Blasio,
Cynthia Collins, designee for Mayor Bill de Blasio.
for Comptroller Stringer,
Jennifer Kondovitz, designee for Comptroller Scott Stringer.
for Commissioner of Finance, Hyman,
Steve Nguyen for Acting Finance Commissioner Michael Hyman.
for the UFA, Andrew Ansbro,
Andrew Ansbro, present.
Bobby Eustace,
Bobby Eustace, virtually present.
Eddie Brown,
Yeah.
Eric Bischoff,
I'll take Eric's proxy until he chimes in.
did we get,
That's Eddie Brown
Okay.
speaking.
okay, Pete DeVita,
John Young with Pete DeVita's proxy.
thank you. For the UFOA, Jack Helpy, UFOA, Liam Guilfoyle,
Hey, Pat, we were
muted, sorry.
Jack and I are both here, and I got Paul's proxy.
and for Fire Commissioner Daniel Nigro.
Carol Brown for Commissioner Nigro.
Good morning. We have a quorum, John. Thank you.
Thank you, Pat. Okay, next, let's move to the Police Pension Fund. Chief Holleran?
Morning, John. Representing the PBA,
Joe Alejandro online.
DEA,
Oh, by the way, is Betty on? Sorry, Betty was having some problems with her audio. If you can let them know that her extension should be 7914.
okay. Diane, you
Yeah.
have
She is on.
Okay, you got her? Did she answer? I'm sorry.
Here, I said I had your proxy.
Okay.
okay, DEA,
Eddie Sparks, thank God Betty's on.
SBA,
Anthony Borelli?
LBA,
Dennis Gannon for Lou Turco.
CEA,
Good morning, Johnny Ramirez for Chris Monahan.
Commissioner of Finance,
Phil Dukes for Acting Finance Commissioner Michael Hyman.
Mayor,
Shuman Rave, designee for Mayor Bill de Blasio.
Controller, Susanna. John?
Actually, I see John. He.
Can you hear me?
Okay, I can hear you now, John.
All right, John, do us a designee for Comptroller Scott Stringer.
And Police Commissioner.
Stephanie Zimberg for Commissioner Shea.
Okay, we have a quorum.
Thank you, Kevin. Next, let's move to NICERS. Ms. Winery,
Good morning, Chair, Mayor's Office,
John Adler, present.
Comptroller's Office,
And David Jeter for Controller Scott Stringer.
Public Advocate's Office,
Elizabeth Guzman for Jamani Williams.
Borough President Manhattan,
Matthew Washington for Manhattan Borough President Gail Brewer.
Borough President Brooklyn,
Tanya Cantlow, representing Brooklyn Borough President Eric Adams.
Borough President Bronx,
Martha Camille Sabia, representing Bronx Borough President Ruben Diaz Jr.
Borough President Queens,
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island,
Isaac Rudetsky for Staten Island Borough President James Otto.
International Brotherhood of Teamsters,
Lawrence Bosley and Ruben Torres for President Gregory Floyd.
Transport Workers Union,
Dave Katzman for TW Local 100 President Tony O'Donnell.
and District Council 37.
Excuse me, that's Ray Santander for Henry Garrido, and I don't know if Robin's on the call.
I haven't seen her scanning the screens yet.
Okay.
We have a quorum.
Thank you, Melanie. And Teachers Retirement System, Ms. Riley.
John Adler,
Yes, I'm present.
Thomas Brown,
Good morning, Patricia. I'm here.
Natalie Green Giles,
I'm present.
David Kazansky,
Present.
Russell Buckley, I thought I saw him, but
Oh, I'm sorry. Did you just call me? I was just making a
no,
call.
but I will now. Deborah Penny
Here.
and Susanna Vickers.
Good morning, I'm here.
Okay, we have a quorum.
Thank you, Patricia. And for BRRS, Board of Education Retirement System, Mr. Rich.
Morning, John. We're represented today by trustee Natalie Green Giles, and well, Russell Buckley was here. He's back. And, we've administered this business already in our Board of Trustees meeting last night. Thank you.
Okay, ahead of the game. Thank you. Okay,
John, this is Isaac, also present.
Oh, Isaac Carmignani is BRRS trustee, also present.
Sorry,
Any
Isaac.
Any other BRRS trustees that Sandy didn't see on his screens? Okay. All right. So we're all present and accounted for. This is our quarterly fund performance meeting. So I'm going to turn it over to the Bureau of Asset Management staff to take us away.
Well, good morning, John, and good morning, all trustees. I wanted to just begin on our last SIM of the year, just wishing everyone and your families a great holiday season. John, we will begin with Mike Haddad with a market overview, and then I will follow with a quarterly update for the third quarter, and then we will wrap up the session with a risk update. So we will turn it to Mike Haddad.
Thanks, Alex. Good morning, everyone, and I echo Alex's wishes for happy holidays for everyone. We all know it has been just a grueling year, and I'm sure everyone like myself is looking forward to the calendar turning. As Alex alluded, I'm going to talk about the public markets performance in Q3. In addition to that, I'm going to spend a little bit of time talking about developments since Q3, and then the last part of the presentation, talk about your strategic asset allocation and where you are relative to your new targets with the bubble graphs. So with that being said, let's just jump right into Q3 performance. Next slide, please, Diane. So the third column, Q3 2020, shows the quarterly returns for the public market benchmarks that are used in all of your portfolios. And a few things to note on this slide. Yet again, another very strong quarter for public equity returns in both US and international markets. And of note, emerging markets actually outperformed the US. We have not said that in many different quarters. As a reminder, as to the returns in the past few quarters, for public equities, Q2 was also positive in the 20-22% range, following on the disastrous performance of Q1 as the pandemic was just getting started, which was minus 24-ish. So if you take your eyes to the fourth column, the 1 year, so that captures all 3 quarters of volatility as this pandemic has kicked in. And you can see positive returns in all 3 equity sleeves, which is really good. And you'll see that reflected in your portfolios, your system's returns that Alex is going to review with you. If we go back to Q3 and down to the fixed income lines, so long duration treasuries were virtually unchanged on the quarter, resulting in very slight positive gains for those different benchmarks. And I will say that interest rates did calm down dramatically in Q3 as compared to the volatility we saw earlier during this period. Credit spreads tightened. You can see the positive returns for both investment grade and high yield. High yield tightened by a little over 100 basis points, though it's still wider on the year. Investment grade tightened by about 14 basis points, resulting in those positive performances. So what's the narrative to assign to these positive returns in markets while the country and the world were still deep in the midst of the pandemic? Next slide, please. I start with the second bullet point. Massive monetary and fiscal response continues. There's been no pullback in any of these programs in Q3. And in fact, today, markets are awaiting anxiously the next fiscal stimulus program, as well as what might happen next year. So this has led to a very strong recovery in GDP, as indicated on this slide. Q3 was up almost 33.1% compared to the 30-some-odd% decline in Q2. So what's most important is what does Q4 and what does 2021 look like? Estimates for Q4 range anywhere from +5 to +8%. 21 is a little trickier. Not sure if we're going to have more shutdowns, for the time being and into Q1, given the spread of the pandemic. But certainly the positive news of the vaccine have left most forecasters with a very positive response in the second part of 2021. Next slide, please. As to employment, very positive news here as well. The graph on the left shows you the decline in the unemployment rate that's taken place since the peak in April. So you can see that steady decline which has taken place in Q3. And the table on the right shows the monthly job gains or losses that have taken place as well. So again, you can see green numbers in Q3. But if you sum these numbers up, the economy is still down almost 11 million jobs. On top of that, the labor force participation rate, which has declined, meaning less people in the labor force by almost 4 million. So despite all the positive news in markets and the vaccine, there are still many, many, many Americans still without jobs. So that concludes Q3. Let me pause there quickly for any comments or questions before I go into developments post Q3.
All right, so any questions for Mike, you should hit the raise hand button on the participants tab on your device. And we'll use that throughout the day today, since I can't see everybody at once. If you have a question, hit that raise hand button. I don't see any right now, Mike, so please proceed.
Thanks, John. Next slide, Dan. So what's happened since Q3? We have had a continuation of an extraordinarily strong equity rally with two primary reasons behind that: the election outcome as well as the vaccine rollout. I'm going to talk each about these in a little more detail, but it's left the equity market in a very, very historically expensive situation. Why was the election positive for markets? First and foremost, this was not a close election. Both the popular vote as well as the electoral college vote, which is the only one that matters, were far in favor of Biden, and any kind of contingent election or contested election, some of the left tail events that we talked about last quarter are not taking place, despite the noise out of the outgoing administration. Second part of the positive part of the election was divided government. The market was fearful of a blue wave, and we did not get that. The Democrats lost seats in the House, and depending on the Georgia election, they may have remained the same in the Senate, or they might have a 50-50 tie. So what's important to the market's perspective is there's going to have to, no one party is going to have their agenda first and foremost and able to implement it. It's going to cause result in negotiations, and that typically is better for the economy and better for the markets. So let me just jump right in with a few more. Next slide, please. So on the left-hand side of this table, this slide, I'm showing a table with the same public equity market benchmarks and the returns that have taken place through Friday in Q3. So you can see very, very strong equity returns. And remember, within that, September was a down month for markets. I'm sorry, October was a down month for markets. And then November is when the equity market started moving higher, again, with the election outcome and of course, with the vaccine news. So this has resulted in long-term interest rates being a little bit higher, almost 15 basis points in Q4 to date. And that's resulted in a negative return in your long duration portfolios. But along with the risk-on environment, credit spreads have continued to tighten. So positive returns in the credit sections of your portfolio. But this equity rally has not been like the equity rally to date. So on the table on the right, I try and capture that. So what do I mean by that? There has been below the surface of the index returns has been a massive rotation within the equity market. The stocks that led the equity market since April are not leading the market anymore. So what do I mean by that? I mean the big tech stocks, the social media stocks, the big five that we hear and read about all the time. Underneath the surface, value stocks, cyclical stocks, stocks that have been damaged, industries that have been damaged by the pandemic. Think travel, think hospitality, think airlines. Those have all rebounded meaningfully, while these big mega cap stocks have basically gone sideways for several months now. So on the right, what I'm showing is that value has finally started to outperform growth quarter to date, both in large cap, which is exemplified by the Russell 1000, and small cap, the Russell 2000. But even though the outperformance in Q4 so far, the right column in this table shows the 3-year performance, with growth still massively outperforming value. So this is a sign of the economy healing and some of these companies who have been damaged getting back on their feet. Next slide, please. So COVID and the vaccine. This is literally the dark winter in the face of a very powerful light at the end of the tunnel. What we're showing on this slide is the relevant graphs for new cases, current hospitalizations, and new deaths. And these are all trending the wrong direction, and enough said on that. Next slide, please. The light at the end of the tunnel is the vaccine. In fact, the first recipient of the vaccine was a nurse in Queens, and the rollout has begun. Pfizer's been approved and is being implemented. Moderna is expected to be approved as early as today. And what we're trying to show on this slide is just on the right-hand side this is just one graph of the tiering system of who's going to get the vaccine first. And again, that will be left to the governors in all the states. But what's important is this is going to take 6 to 8 months until we reach a critical threshold of herd immunity of somewhere between 70 to 80% of Americans have taken the vaccine. And by all accounts, that's sometime between summer and the fall of 2021. Next slide, please. Diane, can we get the next slide, please? Thanks. So this rally in the equity market has left the equity market in a historically expensive setting. So typically, I show you that chart with the decile rankings. As you can imagine, we remain in the 10th decile, the most expensive decile. And a reminder, going back in history, that results in U.S. equity returns of around 0 over a 5-year period. We know history doesn't repeat, but it's certainly worth noting that. So a few other ways to look at the relative expensiveness of the equity market. The graph on the left-hand side is what's termed the equity risk premium. And in very simple language, that's the return that one would expect in the equity market as compared to the government bond market. So very dependent upon where yields are. And what you can see on the far right-hand side of that graph is we're kind of in the middle of where the market has been for the last 7 or 8 years. So in terms of valuation relative to the bond market, it's kind of neutral, it's fair. However, if we take our eyes to the right-hand side of the slide, there's several more valuation metrics that we'd like to point out. And the first 8 of these, so above that black line, 3/4 of the way down, all of those valuation metrics are based more on earnings or cash flow. And as you can see, on the right-hand side of this table, the current the current valuation of those metrics is listed. And then importantly, on the right in the blue is where these valuation metrics fall in some type of multi-year backward-looking historical metric. And you can see for all of these metrics that the equity market is expensive on an earnings basis relative to where it's been over the past several years, and at the most expensive level in some of these. We take our eyes to the bottom part of this graph. These are valuation metrics that talk about the yield on the equity market as compared to investment grade, and the yield on the equity market as compared to rates. And so we can see, as if we measure the equity market as compared to the bond market, we're much more reasonably valued. Next slide, please. Another source of concern in the equity market is the concentration of the top 5 names. So what this graph shows you, the black line is the NASDAQ, and this is with the top 5 stocks, what percentage they are of the total index. And what's important for the NASDAQ is that we are meaningfully higher than where we were going into the NASDAQ bubble. The blue line is the S&P 500, and again, you can see the top 5 names make up, in the mid-40% of the total market cap. Historically, that has not led to good returns in the future. Next slide, please. As I mentioned, metrics that are not expensive is when we compare the equity market to the bond market. So the left-hand side is just a simple graph of the 10-year note going back to 2006. We chose that time frame because that's pre-global financial crisis. And you can see the 10-year yield has fallen from 5% to that point to somewhere, in the low 90s where it is now. So a massive decline in rates. And anytime, you're going to measure something using a discount rate, the lower the discount rate, the higher the NPV is of that calculation. So the yield on the government bonds have a very meaningful impact as how the market views some set of cash flows for the equity market. So important to us is, well, can 10-year notes remain this low in the face of what looks to be like an extraordinarily strong economic recovery as the vaccine gets rolled out, a massive increase in budget deficits. This is the offset to the fiscal stimulus. And then lastly, the adoption of the average inflation target by the Federal Reserve. Why is this last one important? Because this took place in August of this year. We talked about a little bit at the last SIM. So the Fed is no longer concerned about keeping inflation low. They actually want inflation higher. So typically when you get higher inflation, that is not good for a set of fixed cash flows, which is what the long treasury securities are. And that should result in higher yields, all things being held equal. Next slide, please. A couple more sources of concern. The graph on the left side is a long-term graph going back to 1900. And it shows the relative valuations of both the equity and the bond market as compared to this last 120 years. The blue line is the Shiller CAPE. So again, this is one of these valuations that's based on earnings. And you can see that we are at or near the all-time high of that. The orange line is the 10-year yield. Again, at or near the all-time low in yields. The combination of these valuations are extraordinarily high where we've been in history. All of our portfolios have benefited from these rallies. Going forward, this is going to be a source of concern. The graph on the right is just a glimpse, again, going back 100 years, of the correlation of returns between the equity and the bond market. And as you might expect over that long period of time, that correlation has shifted. It's been positive for decades, and it's been negative for the past 20 decades or so. Why is this important to us? As you recall from the many different strategic asset allocation discussions that we embarked on earlier this year, our core fixed income portfolio is designed to serve as a risk mitigant to the equity portfolio. And it has worked beautifully during this time period. How that correlation reacts going forward, less clear, obviously not knowable, but something that we are concerned about. And to that point, we have initiated discussions with all of your general consultants about doing some kind of review of the role of the core fixed income portfolio going forward in your portfolios, given everything that's taken place in 2020. So we're going to be focused on that as we turn the calendar into next year. So that concludes my current market developments part. Next up is rebalancing in your asset allocation. So let me again pause for any questions or comments here.
We have a question from Mr. Edward Brown.
Yes, with the race, the Senate race in Georgia, I heard we said that there were positives in the market of the election, right? So depending on the Senate race in Georgia, if they raise the corporate, if the taxes go up, the corporate tax rates go up to 28%. And they're talking tax the rich and tax this. And I see Jamie Dimon and them moving out of New York to Florida. How does that affect us in the market? I mean, usually if tax rates go up, the market's going to go down.
I didn't see the news that Jamie Dimon's moving to Florida. A lot of other people moving to Florida, but I don't think Jamie's going. Eddie, you bring up a good point. The election.
Actually, in the news, it says that Jamie Dimon is talking about moving parts of his company to Florida.
Is that in the news today? I missed that.
Yesterday.
Okay. So you bring up a good point. Two runoff elections, January 5th in Georgia. That's the Senate as it stands today is 50-48 in favor of the Republicans. And if the two seats do go to the Democrats, it gives the Democrats a 50-50 tie with the Vice President-elect Harris serving as the tiebreaker. The assumption that you're getting to is that ends up being a democratically controlled Senate. Not so clear. 50-50 is a tie. They do get the tiebreaker vote, and that assumes every senator votes right along with their party and what their party's trying to do. And maybe I'm just being hopeful, but I think as we turn the page and we get onto a new president, it's going to be a very different type of president, very different communication style, very different style of working with Congress. Biden and McConnell have a long history of working together in the Senate, and the hope is that it becomes much more reasonable. That being said, you bring up a couple good points, and this is what I referred to earlier as the blue wave. In a blue wave environment, I think most market participants thought that would have been negative for the equity market because, to your point, part of the Biden plan, if you will, had meaningfully new tax revenues and meaningfully new spending goals. And in that increase in revenues was an increase in the corporate tax rate. And I concur with you, all things being equal, higher taxes are not good for earnings. And if earnings are going lower, that's probably not good for the equity market.
On a second question, if all these big companies go to move out of New York, what's our recourse as the five funds? Is there a way for us to say, if you're going to abandon us, we're going to abandon you?
I don't have a good answer for that. I share your the direction that you're going with your comment. What do we do in our roles of you being trustees and us being one of your investment advisors? We're still stuck with trying to maximize our risk-adjusted return. But I hear you on that. It's a major challenge our city faces. And even with the vaccine rollout and assuming we get back to normalization, whatever that means in the second half of 21 and into 22, certainly the use of office real estate has changed and probably permanently. And that's going to be an impact on our city, given all the businesses that reside here. It's really incumbent upon the next set of leaders of New York to try and figure this out. And it is a complicated situation. And I'm sure
we had the hedge fund guy, I can't remember his name. He's based out of Florida, and a couple of people were making snarky remarks, which I agreed with, that who bases himself down in Florida. Now it seems like the tide has turned where these companies are saying, yes, we're going to go to Florida. We're going to get out of New York. We're going to get out of California. And I think for the pension system, if we office space and everyone starts abandoning Manhattan, we're in trouble.
Okay, thank you, Mr. Brown. Next question is Mr. Raymond Santander.
Thank you, John. Good morning, Mike. How are you?
I'm well, thanks, Ray. You?
Good, thank you. So I haven't heard any comment about potential for a new stimulus package. So I was wondering whether that has been baked into forecasts or calculations, and sort of what's the market thinking, or what is and BAM's thinking on this?
I think the markets are expecting a positive outcome today or maybe even tomorrow on version 1 or 1A. Version 1 is the 908 billion. That includes 160 billion to states and cities, along with some kind of immunity shield for companies. That appears to be the sticking point between the two parties. And version B takes both of those out of the equation, and it's something like a $750 billion package that I believe that market participants expect to get agreed upon today. All the signals are there. The relevant parties worked late into the night last night on it. So I think that's in the price. And then your question is an excellent one. What about next year? And that I think has a lot of uncertainty about it. Certainly the outcome of the Georgia elections is going to have an impact on that, with the obvious directions. And just as a reminder, Congressman Pelosi, pre-election, her plan, the HEROES plan was 3.3 trillion. Let's fast forward to past January 5th. And if the Democrats have control of all three branches of government, is she and her party going to ask for something even greater than that? Don't know. And again, if you think about this is a bridge to get us through this dark time when the pandemic is still causing massive problems. We're still down 14 million jobs. And we need stimulus to get us through to the light at the end of the tunnel. And that light is not when we're all vaccinated, because there's going to be unknown implications to many different companies and many different industries as we emerge from this in the new economy and the new environment. My guess would be the markets expect an additional stimulus package in the first quarter of the year, and whether that is another 1 trillion-ish or something greater, I think has a lot to do with the outcome of the Georgia election.
And Mike, just a follow-up, and we've discussed it in the past. Is there enough fiscal capacity to keep doing, $1 trillion stimuluses and then maybe even a $3 trillion stimulus? I know that the U.S. debt it's 100% of GDP now, or maybe even higher.
So we've been lucky at BAM to, we speak to our managers all the time about, the obvious things, but one of our managers, Warburg Pincus, the president of it is Tim Geithner, who's a former Treasury Secretary under Obama. And we got to have a fireside chat with him a couple months ago or so. And I asked that specific question. And the answer he gave, which is consistent with a lot of the Democratic economic and thought leadership. So what do I mean by that? I mean Tim, Janet Yellen, the incoming Treasury Secretary, Ben Bernanke, Larry Summers, Jason Furman. They've all kind of taken a new stance on this, right? And they say, when you look at the level of interest rates, it's interest rate coverage that matters a lot to the size of your deficit. And with interest rates low now and expected to stay low over a long period of time, given the disinflationary impact of our economy from technology, as well as the demographics in our country, that interest rates are likely to stay low. And if that is the case, and that's a big contingent statement, then we can run a higher deficit and be okay than we could have otherwise. So again, think back to that 10-year graph. At a 5% yield on the 10-year note, your cost of servicing the debt is a whole lot higher than if the yield on your 10-year note is 90 basis points. And you can just kind of do the whole yield curve to get that answer. So the incoming administration it's pretty clear that all of their policymakers are of the view that we can run higher deficits than before. Let's knock on wood that they're correct. The other important thing that Tim shared with us, in his opinion, but I think we all respect his opinion. He said the tipping point comes, you don't know where it is. And unfortunately, when it does become a tipping point, it's probably too late and you're going to suffer the consequences of it. You think about the European debt crisis, for Italy and Spain and many Southern European countries. It was all okay until it wasn't. And yields shot up hundreds of basis points. Their equity markets crashed, their economy crashed. And that's the situation we don't want to get into. So we have to be careful. All the economic textbooks would argue as deficits go up, companies and individuals change their behaviors such that they know they have to pay it off some point through higher taxes, and they start saving more. So that's the counter argument to that. And I can't say I have a strong opinion one way or another from an academic standpoint, but the damage to the economy from the pandemic is massive. And if there's ever a time to borrow more and try and support the entire country through this time period, it's now.
Okay, thanks, Mike. I don't see any other hands, and I think we'd like to move it along in the interest of keeping to our schedule. So, Mike, does that conclude your presentation?
No, I'm going to talk about rebalancing and your asset allocation, your bubble charts.
Okay, take us away.
Okay, so here's a summary of the rebalancing activity in Q3. You see at the bottom of this, 10 billion of outflows, 10 billion of inflows. The vast bulk of this activity had to do with the different sleeves of maturity, said differently, duration in your government portfolio. So there was money under Robert, there was money moving around to these different sleeves, but it's important to note that your durations were at or near your target at the end of Q2. They remained there through all of Q3 and ended there at Q3. So this was just moving around in a duration neutral factor to where your new allocations dictated. The second thing to note is you'll see in the top part of this, a lot of activity for the police portfolio. And as a reminder, police approved their asset allocation later than the other four systems. So the rebalancing team was busy moving money into the direction of the new allocations. And what did that mean? That meant more money into mortgages, more money into investment grade credit. Next slide, please. So as a reminder, these are the bubble graphs that we share with you, which show each of the 5 systems color-coded and where they are relative to the new asset allocation targets. The gray bars are the rebalancing ranges, and these are the old rebalancing ranges. We have not gotten approval from all boards yet on rebalancing ranges, so we have not updated those as of yet, but the targets are all updated. Takeaways from here. U.S. equity at or slightly underweight target. Next column over, international equities, EFI slightly above, emerging markets slightly above. The net of all 3 of those is you were at or near your equity target throughout Q3. The green up arrow and shading for hedge funds, police and fire continue to have slight overweights to hedge funds, and that's part of the tactical trade that remains in place, the only tactical trade that remains in place, and even those have been reduced slightly in Q3. Some noise around the high yield that I want to mention. The BRRRR bubble is well below the rebalancing range. As a reminder, BRRRR adopted an OFI allocation in the asset allocation. The half of the placeholder for high yield is half the placeholder for OFI is high yield. And we haven't funded any of the OFI yet, still working on that. So that placeholder stands out, but that bubble is moving in the right direction. Next slide, please. Here are the bubble charts for your inflation protection portfolio. Again, at or near your targets. The one thing that stands out on here is the bank loans. All systems drop bank loans, and Wesley and team have been busy liquidating those. We were fortunate that bank loans have recovered along with most other asset classes, and the bulk of our liquidation has been into a very strong marketplace in bank loans, and we're happy with the way we've been able to dispose of a relatively illiquid asset class. So those, if I'd updated those for today, they would be just slightly above 0. We expect to be 90 to 95% liquidated by the end of the quarter. Next slide, please. This is your deflation protection portfolio. This is your core fixed income portfolio. Credit, as you can see, is slightly underweight, and we're okay with that. Credit spreads have come in tremendously, and they are close to where they were pre-pandemic. And the other thing I'll point out is on the government sleeve, you can see some bubbles all over the place there. As a reminder, what matters most about your core fixed income portfolio is not your AUM, but your duration. So let's go to the next slide, please. Here are the durations for all 5 systems. The first row shows your previous asset allocation duration. The second row shows your new duration target for the core fixed income portfolio. And the last line shows where that duration was at the end of Q3. And as I had mentioned before, you have been at or near your duration targets for the last several months. John, that concludes my part of the presentation. So I'll ask again for any questions or comments.
Any questions for Mike on the asset allocation? Okay, I don't see any. Thanks, Mike.
Thanks, John.
So Alex, does that bring you up?
It does. Thank you. Let's turn to the next page. Great. So we'll begin quickly here on this first page, which just shows AUM for all systems through the end of the third quarter. And you'll see that in aggregate, the system's AUM is at about $225 billion. Next slide. So for the third quarter, returns by systems range from 5.4% for FIRE to 6.22% for BRRRR. The systems posted strong gains in the quarter as global equity markets continued to rebound from the lows of Q1. Now, in the quarter, the systems outperformed the index portfolio, as you can see in that third column from the right. That's primarily driven by the system's exposure to emerging markets, which performed strongly, as you heard in the last presentation, and the system's exposure to private markets. Now, when you think about it, the actual index, in an index portfolio, the 65% equity component of that is 43% US equities and 22% non-US developed markets. So no exposure to emerging markets, which is strongly for the systems. And the fixed income portion of the index, as measured by the Barclays Agg, only returned 63 basis points in Q3, hence the system's outperformance versus the index portfolio. Just looking at a little bit of the returns by system and some of the differences there. I'm looking at police and fire, slight relative underperformance to the other systems in the quarter. And that was due to their lower allocations to US equities. In addition, their relative exposure to US value-oriented managers, which underperformed growth in Q3. And the hedge fund portfolio underperformed slightly in Q3. Just looking at BRRRR, which had relative outperformance to the other systems, that's primarily due to their higher exposure to US equities and very strong EFI returns. Now, given the strong performance of the equity markets over the last 2 quarters, the systems have exceeded the 7% assumed rate of return for the trailing 1-year period. In addition, the systems have returned in excess of 7% in the trailing 3- and 5-year periods as well. Now, all systems except NYSERS for the 3-year trailing period have outperformed an index portfolio and also outperformed other large pension plans as measured by TUX in the 3- and 5-year periods. And as a reminder, the TUX line here, the bottom line of this chart, of this table, is reported gross of fees. Next slide, please. Yeah, so here we have total portfolio performance for each system in Q3 versus each system's custom benchmark. Now, all systems slightly underperformed versus their custom benchmark in the quarter, as you can see from the bar chart on the far right-hand side. The horizontal line, that one in blue there, represents the 7% assumed rate of return for the quarter, and all systems significantly exceeded the assumed rate of return. Next slide, please. Now, when you break down the components contributing to the lag for all systems in Q3, you'll notice that it's primarily due to manager value add. That's the table on the far right-hand side. The system's managers underperformed their benchmarks, particularly in public and private equities, and also private real estate. In the following slides, I will highlight performance by asset class, so you can see what I'm talking about here. Next slide. So here we show US equities performance versus the benchmark for each system. Each system underperformed their respective benchmarks in the quarter. The story here, as you heard in the last presentation, is that US equities for the quarter continued to be one where growth stocks outperformed value stocks, and large cap stocks outperformed small cap stocks. So for the systems, their underperformance was driven primarily by their active managers exposure to small cap and value. And for BRRRRs, you did have your mid cap active manager that also underperformed. Next slide, please. So here we have the EFI portfolio for the quarter. All systems strongly outperformed. Non-US developed equity markets continued to recover in Q3, although they did lag the performance of the US and emerging markets. Now, continued dollar weakness was a positive in the quarter and helped to drive returns in US dollars. Lastly, I'll mention that active managers in the aggregate across the portfolios delivered strong outperformance versus their respective benchmarks, particularly those with a growth orientation. Next slide. Now here we show the emerging markets. Performance was mixed across the systems, as you can see from the table on the left-hand side. NYSERS and teachers managers outperformed their respective benchmarks, while for police, fire, and BRRRRs, underperformance was driven by value-oriented managers in your portfolio. Next slide, please. So here we have the fixed income portfolio. Overall returns in the quarter were generally flat versus the benchmark, as you can see on that first table from the left. Now, fixed income markets were relatively calm in Q3 compared to the volatility we witnessed earlier in the year in Q1 and in Q2, and they generated positive returns with the Barclays Agg up about 63 basis points in the quarter. Now, disaggregating this portfolio, let's first look at treasuries. So in treasuries, yields were range bound during the quarter with the 10-year closing essentially flat to where it stood at the end of Q2. And the government's portfolio returns were in line with the benchmark. Now, mortgages did well in the quarter as spreads tightened by about 10 basis points. And in addition, mortgage managers had strong outperformance versus their respective benchmark. And investment grade credit also had strong performance, actually outperforming both the treasury and mortgage sleeves in the quarter. And this is driven by high inflows in search of yield that led to spreads tightening in the quarter. And your IG credit managers had strong outperformance versus their respective benchmarks. Next slide, please. Turning to high yield continued to rebound strongly in Q3 as the index returned about 4.6%. All systems slightly outperformed the high yield benchmark, with opportunistic managers leading the way. Now, core high yield managers also exceeded the benchmark as they were able to capitalize on the rebound in COVID impacted sectors such as transportation, leisure, and energy. Let's turn to hedge funds on the next slide. So here's the hedge fund portfolio for police and fire. The hedge fund portfolio underperformed the benchmark in Q3 as equity markets significantly rebounded. But the portfolio, more importantly, has outperformed very strongly in the calendar year-to-date period, that middle column, and over the last 3 years, last year trailing period, the far right-hand column. Now, when you disaggregate the hedge funds portfolio, the direct hedge fund portfolio, while slightly underperforming in Q3, has significantly outperformed the benchmark this year to date and over the last 3 years. And the tactical trade has underperformed for the quarter and since inception as the equity markets have rallied. Next slide, please. So now we're turning to the private asset classes, beginning with OFI, performance through Q3. The OFI portfolio is trailing its benchmark since inception, as you can see here, versus the public markets or the public market equivalent, or PME, plus a 300 basis points illiquidity premium, which is the benchmark. Now in Q3, the OFI portfolio had a return of about 4.95%, outperforming the custom blended PME benchmark, which returned about 4.52% during the quarter. Now, gains in the OFI portfolio were driven by opportunistic managers. When you look at the direct lending strategies, those strategies did underperform in Q3 as the mark-to-market gains that some of your managers were able to post did not keep up with the strength in the underlying public market benchmarks. Let's turn to PE on the next slide. So for private equity, we have performance through Q2. Again, performance is reported on a lag. And since inception, returns for the systems range from 9.7% for NYSERS to 11.4% for BRRRR. Now, as you can see on this chart, all systems, with the exception of NYSERS, either were flat, are flat, or exceeded the public market equivalent since inception, which is a Russell 3000. However, the systems continue to lag the PME benchmark, which is a Russell 3000 plus the 300 basis points illiquidity premium. Now, the overall returns, if you look at the quarter, back to the quarter results, improved by about 52 basis points in Q2 over Q1. If you look at the PME, though, the public market equivalent, or the benchmark, actually increased greater by 150 basis points in Q2 over Q1. So that PME spread of the portfolio to the markets decreased by about 98 basis points from Q1 to Q2. Now, as I noted last quarter, and I'll repeat, the PE portfolio and the valuations of the PE portfolio are not as volatile as the public markets, certainly during these times of dislocation. To give you for instance, and an example of your own portfolio, if you look at your benchmark, the Russell 3000, the Russell 3000 total return index was down about 21% in the first quarter, and then up 22% in Q2. And if you look at the portfolio marks and the portfolio PE portfolio valuations, it was down in aggregate 9.5% in Q1, as I mentioned last quarter, and up 9.8% in Q2. Let's turn to the real estate portfolio, the next slide. So beginning with core real estate, now looking at the second quarter again, since inception performance for the core real estate portfolio, it is underperforming the PME benchmark, as you can see on this slide, for all systems with the exception of BRRRR. Now, core real estate valuations, again, were written down in the second quarter versus Q1, and that's driven by continued weakness and distress in hospitality and the retail sectors. Now, the portfolio's underperformance versus the PME widened in the quarter as the markets again staged a recovery in Q2, while the portfolio marks were marked down in the quarter. Let's turn to non-core real estate on the next page. So looking at the second quarter since inception performance for non-core investments, they're outperforming the PME benchmark for all systems with the exception of FIRE. However, similar to the core portfolio, the non-core portfolio was also marked down in Q1, while the underlying public market benchmark recovered strongly in the quarter. So you had, again, the PME spread widened for the non-core portfolio. And then for FIRE, once again, the relative underperformance since inception, which you see on this slide, is once again due to the exposure that you had to pre-GFC investments that continue to be a drag on the portfolio since inception returns. And last but not least, we'll turn to infrastructure. So the infrastructure portfolio continues to perform very strongly. The portfolio today is about 52% funded and diversified across 166 companies. Primary exposures that the systems have is to renewables at 25% of the portfolio and transportation at 21%. But as you can see here, once again, performance continues to be strong for all systems, and the portfolio has outperformed the PME benchmark and the IPS benchmark, which is a CPI plus 400. With that, I will pause for any questions.
Okay, any questions for Alex? Hit the raise hand button on your participants tab. And I don't see any. So Alex, I think you can proceed.
So we will turn, thank you. We'll turn to Dan Haas with our risk update for the quarter.
Thanks, Alex. Good morning, everyone. How are you? Today, we'll spend a few minutes reviewing some highlights from your quarterly reports that you haven't convened. for the quarter ended September, and then we'll dig a little deeper into the U.S. markets concentration phenomenon that Mike was alluded to earlier. Here on this slide, as always, is an example of the risk summary that appears on your quarterly reports. Again, looking at the top left panel, you'll note that the total plan risk for the quarter ended September 30th was 14.7%, which was down slightly from the 15.44% we reported in June. This was due primarily to market phenomena, which we'll discuss in a little more detail in the next slide. And then similarly, our benchmark risk, which corresponds to the portfolio policy allocations, was 13.77%. Again, that was down slightly from the 14.65% that we reported back in June. The table and the chart, again, moving across the top, so the center and the right sections there, show you the differences between the portfolio allocation by assets and your allocation to risk. Similar to the last quarter, you'll notice that we're effectively 2/3 allocated to equity, 1/3 allocated to fixed income. However, we see that roughly 90% of the risk in the portfolio is coming from equities. The chart that you see on the right there simply restates information that you see in the table. It's a graphical representation, and here, of course, the yellow bars correspond to your risk contribution and would link up to the axis on the left, and the red dots are your asset allocation weights, and that corresponds to the axis on the right there. As we move down to the bottom panel, again, as past quarters, we plotted the 1 year trailing portfolio risk, which is represented by the blue line, the 1 year trailing benchmark risk, that's a red line, and then the portfolio beta, which are the gray bars there, for the year ended in September 30th. Again, as a reminder, this is a monthly plot of our forecasted risk based on MSCI's long-term model. And again, same observations as last time. You notice that portfolio risk jumped up in April as the long-term models picked up market events in February and March, and have remained at that higher level ever since. As I mentioned earlier, of course, this quarter saw slight declines in both benchmark and portfolio risk, which we'll examine in a little more detail on the next slide. Can you go to the next slide, please, Diane? Thanks. Here, we're decomposing the change in risk from June to September into three kind of broad categories. The change in volatility, the change in correlations, and the change in portfolio exposures. The change in volatility and the change in correlations categories are market-driven phenomena, meaning that these risks decline in step with market risks and were not the result of specific position weights or tilts in the portfolio. You'll see those corresponding to the blue arrows on the table there. If we bring our attention to the second line of the table, you see that the reduction in market volatility accounted for 62 basis points of the overall 74 basis point reduction in risk. A big chunk of this was driven by industry factors, most notably our tech-related industries. We saw some of our largest volatility factor reductions in U.S. internet and IT services, U.S. software, and U.S. computers and electronics. We also saw some contribution from U.S. financials and U.S. healthcare sectors. And then a smaller but significant portion of that 62 basis points we're reporting there was driven by reductions in spread factors. So again, that's corporate spreads kind of coming in a bit. Here, the big change was led by the U.S. energy and the U.S. financial sectors. Moving to the third line, we see an 18 basis point reduction in risk attributed to correlations. Here we derived a benefit as markets settled somewhat from the immediate impact and recovery of the COVID crisis, and correlations relaxed a bit, which offered us greater overall diversification. Looking at the factors exposure driving this reduction, we see tech leading the way again. U.S. software, U.S. biotech, and life sciences, U.S. internet and IT services all showed significant reductions. Finally, the portion of the portfolio risk that was detached from the market trends is grouped in the last line there, labeled change in portfolio exposures. That's the red arrow, if you're following along. Here, the risk increased very slightly by 6 basis points. And as we dig into this, we see that the change was driven by industry exposures, specifically our allocations to consumer electronics and information technologies was driving this change. All in all, these movements aren't particularly large in a historical context. However, it's good to understand what's driving the change and follow these for trends. It was a bit of a mouthful, of course, kind of going through this, and it's a new construct that we're trying out on you this quarter. So I guess before I move on, I just want to pause and see if you have any questions.
Any questions for Dan on this so far on the risk report? I don't see any, Dan.
Okay, great. Go ahead, Diane. Thanks. Okay, back on more familiar ground on this slide, we're presenting the factor risk decomposition, again, featured in your quarterly packages. Investment factors there, as you recall, represents exposures that cut across our traditional asset classes. And this slide is meant to sort of paint a picture of how that works. The table at the top left allows you to examine our exposures to MSCI's macro factors. The risks here are decomposed among two principal categories, your local market risk and your currency risk. And you can see the components of each of those broken out among the rows of that table. Looking along the columns, you find that the portfolio and active risks are broken out in absolute and percentage terms along with their respective correlations. This is kind of just a good quick guide to show you which factors are contributing most or least, I suppose, to your portfolio risk. The table at the top right, or sorry, the chart at the top right there, shows which factors contribute most to our active risk or our tracking error. As before, you'll notice that the private equity factor, pardon me, is responsible for the majority of our tracking error. And that simply has to do with the fact that we're using the Russell 3000 as a risk benchmark for our private equity investments. So that creates a bit of noise in the numbers there. Down below, we're plotting our factor exposure among our broad equity and fixed income allocations. As before, you see that the risk is dominated by our equity factor, represented by the light blue shading, which is followed by real estate, fixed income, and currency. Important to note here is that we have some equity exposure in our fixed income strategies and a bit of fixed income exposure on our equity strategies. So that covers the review of the quarterly reports. I guess if we move along to the next slide. Thanks, Diane. Here we're examining a theme that we see popping up in the U.S. public equity markets. Mike, in his presentation, discussed markets' historically rich valuations and the fact that a large portion of the returns have been driven by relatively few market participants. Similarly, it's widely reported that the FANG stocks, comprise a significant portion of the S&P 500. It's been growing, and while no one can know whether the relative success of these few companies is a permanent change or that will someday revert to closer to their historical levels, there are huge implications on our portfolios as most of our exposure is derived from the U.S. equity market. Next slide, please, Diane. So as further evidence of this point, we found this slide, which compares the top 5 of the largest weighted constituents in the MSCI USA Index to the top 5 constituents in the MSCI World ex-USA Index. The top panel there gives you metrics for the MSCI USA Index. It breaks out risk and performance metrics for each of the top 5 companies in the index, and in the top section there, and it shows you the group total and compares that total to all of the other members of the index. There are 618 companies in the MSCI USA Index, and these top 5 companies, as you can see, accounted for 1/5 of the overall risk in the portfolio, and drove, surprisingly, or perhaps not surprisingly, 3/4 of the return year to date of that index. As you can see, this is measured through November 6th. If we look at longer historical periods, over 2 and 3 years, again, we can see that these 5 companies derived or drove perhaps a little bit more than 40% of the performance over those horizons as well. Contrasting the metrics of the MSCI USA Index with the MSCI World ex-USA Index down below, you can see, again, the same metrics. The MSCI World ex-USA Index is a slightly broader index. It has 982 companies relative to, as opposed to the USA Index with 618. But you can see in the table that the top 5 companies in this index contribute far less to the overall risk of the portfolio and drive less of the overall return. So again, this is meant to sort of underline the theme that we've been sort of talking about over the last year or so. Just another piece of evidence, the MSCI USA index has a slightly different composition in their top 5. But you see the theme kind of playing through here. USA is sort of dominated by large tech companies, whereas the MSCI World ex-USA, you see some consumer staples and healthcare. I think one of them is information technology, but the weighting difference is driving quite a lot of risk and quite a lot of return in the USA, and we don't see that playing out in other developed markets portfolios. So with that, I just want to see if there are any questions before we wrap up.
Any questions for Dan on the risk report? Okay, Dan, you either answer all our questions or nobody has any idea what you're talking about. Thank you.
Yeah, thank you. Have a great day, everyone.
Thanks, Dan. Alex, does that conclude the quarterly performance?
Yes, it does.
Great. And so if I'm not mistaken, that concludes our public agenda for this morning. Is that correct?
That is correct.
Okay, so we're now going to entertain motions from each board to exit public session and enter executive session. So let's do them one board at a time, starting with teachers. Is there a motion at teachers to exit public session and enter executive session?
Don't move, John.
Thank you, Mr. Brown. Is there a second?
Second.
I couldn't hear who did the second at teachers.
Give it to Susanna.
Susanna. Okay, thank you, Ms. Vickers. Any discussion? All in favor of the motion at teachers to exit public session, enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Okay, at NYSERS, is there a motion to exit public session and enter executive session?
So moved.
So moved.
Thank you, Mr. Washington. Was that a second, Mr. Bosley?
Yeah, second.
Thank you, Mr. Bosley. Any discussion at NYSERS? All in favor of the motion at NYSERS to exit public session and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Next, at police, is there a motion to exit public session and enter executive session?
Joe Alejandro moves that we go into executive session.
Thank you.
I'll second that.
Thank you, Mr. Alejandro, and thank you, Mr. Dorsa. Any discussion? All in favor of the motion at police to exit public session and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. At police and at fire, is there a motion to exit public session and enter executive session?
So moved. Carol
Thank
Brown.
you. Thank you, Ms. Brown. Is there a second?
Second, Liam.
Mr. Guilfoyle, was that you?
Yes, it was.
Okay, thank you, Mr. Guilfoyle. Any discussion? All in favor of the motion at fire to exit public session and enter executive session, please say aye.
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 All opposed, please say nay. Any abstentions? Motion carries. We are now in executive session at all the boards. Can we please turn off the cameras?